Okay, awesome. I want to thank you all for being here for the presentation of the performing versus non-performing note investment webinar. My name is Jerry Wallace. I'm with FiveWB LLC. I'm going to be joined by our partners this evening on this presentation, Nicole Capurso and Ian Robertson. They're going to tell you about some of the awesome services that Madison Trust can offer you in terms of self-directed IRA and other services. I'm going to be jumping into a screen share here in just a few minutes as we welcome you to tell you about some of the background information and how you can begin to make some educational decisions about whether you want to pursue performing or non-performing note investments. Again, this is an educational webinar, not meant to be investment advice, just educational in nature. We're going to try to help you understand a little bit more in depth what performing and non-performing notes are and how they might be of benefit to you. I'll be turning things over at the end of my presentation to Nicole and to Ian so they can tell you about their services. For now, let me jump into the screen share and pull up the presentation for the evening. Okay, very good, very good. Love it when technology works great. That's awesome. Okay, folks. So again, thank you for taking a few minutes to talk with me. My name is Jerry Wallace. I'm with FiveWB LLC. I want to talk to you about performing and non-performing real estate notes. Before I jump into that, let me tell you, I'm not a financial planner. I'm not an attorney, not a CPA. And I really want to make sure that you know that investing involves risk. I am very familiar with the note industry, feel very solid in what I'm going to present to you today. Love it, seen it do a lot of great things for many people, but want you to know that any actions taken based on the information provided are at your own risk. I can't be liable for any losses or damages that you decide to go out and do on your own based with this educational information. So you may have guessed by now, my attorney made me say that. But we have to let you know that to be fair and upfront with you, you should always consider your own financial situation, risk tolerance, which we are going to talk a little bit about, and your own investment goals before making any decisions. So a little background about myself. I'm the managing member of FiveWB LLC. I started working with real estate in '01. Have a public administration master's from Northern Kentucky University, been in business management for a little over 20 years, have 5 boys that I'm very proud of, and I'm the founder of a nonprofit organization that helps people in the Cincinnati area with reentry employment. So welcome to learning a little bit more about the pros and cons of performing, non-performing note investing. Tell you what we're going to cover today. We're going to talk about the comparison of performing versus non-performing notes. We're going to talk about your individual suitability based on individual investors' risk tolerance. Then we'll do some final tips and takeaways. So what is real estate note investing? Real estate note is simply a promissory note that is secured by real estate. It's nothing more, nothing less. We, FiveWB, we purchase real estate notes to invest like a bank does so that we can collect the monthly payments and earn a good, well-secured return. That's really what this is all about. So performing versus non-performing notes, how does each type of note work? What are the pros and cons? Performing notes, the pros are consistent cash flow. You're going to have lower risk and higher liquidity. You can move them more easily should you need to do so. You're going to have a little bit lower returns, naturally, as compared to non-performing notes. There's less risk, and there's more buyers competing for those notes. Non-performing notes, of course, conversely, have higher returns, lower purchase price, which is very nice. You can, if it's your goal, have an opportunity for asset acquisition. The cons, higher risk, uncertain cash flow. And this is really the big one, folks. Potential legal challenges, right? You could end up in a foreclosure, right? That's what comes with, what is a non-performing note? It's literally a note where a notice of default has been filed and most likely a foreclosure action has been started. That's the reality, folks. So let's jump in and do a performing note case study. I love doing these studies to help people understand the details, the note analysis, and really begin to understand the suitability of each type of note investment for them. This note is a $258,000 fair market value property with the $235,400 note being sold for $188,320. And you'll notice in the screen on the left, above the picture on the left, that's a very significant discount, over a $47,000 discount. It amounted to, if you look at the bottom of that slide, a 73% investment to value ratio. That's very good. The deal analysis portion tells us that the note has an 8.2% interest rate. It's being offered at a significant discount, which brings the yield, okay, which is higher in this case because we bought it at a discount than the face rate of the note, up to almost 11%. It's a very good investment to value ratio at 73%. Now, what is the exit plan with this particular performing note, to give you a little more insight into what we typically do with performing notes? It's to hold long-term and enjoy an above average yield, almost 11%. That's certainly an above average yield with a well-secured real estate backed note, in this case with 346 months left. Now, let's take a look at a note case study for a non-performing asset, non-performing note. This one, it was actually based in Tennessee. It had $165,000 fair market value. $140,250 is the mortgage note being sold at $74,322. That's a very, very significant discount. It's one of the things that we love about the note industry, is that we are able to get some very significant discounts on these notes as we work through them nationwide. Came out to almost a $66,000 discount at purchase, resulted in a 45% ITV, investment to value. Now that is a big benefit as compared to the performing note, right? Who wouldn't want to be in at 45% investment to value? That is awesome. The deal analysis here, this note was at an 8.5% interest rate, monthly payment of $1,277.51, had 213 months left on the mortgage. Now, big difference notification here again, right? No payments have been made for 7 months, folks. You have to recognize that and realize that. That is the major difference. If you're thinking in terms of, well, why wouldn't everyone just take the higher yield, right? That's it. That's why. That's the showstopper. If you don't have the preparation for that situation, the 7 months of arrearages and the capital to plow through that scenario and get to make it to the other side, non-performing notes are not the place to be, right? These are going to be 6 to typically 12-month workouts, folks. That's what we're talking about versus picking up performing notes that provide monthly positive cash flow at the outset. Now, I'm going to transition into 3 possible outcomes. It's very important to talk about this so that we can recognize and talk about how we deal with the 3 possible outcomes of non-performing notes, okay? Their loan modification, which you'll see here, that 50% indicates that happens in about 50% of our annualized deal flow. C4K means cash for keys. If you've ever been or are currently a landlord, you probably know that cash for keys is the reasonable way that we help people move on from an untenable housing situation, right? This is a deed in lieu where a person can simply no longer make the payments, and we help them with some financial assistance to go ahead and move on to their next best housing option. That ends up taking about 25% of our annualized deal flow. And unfortunately, for us anyway, because we're not looking to go through foreclosure at any point, and certainly not any more than necessary with our deal flow, but we do still have that happen with 25% of our annualized deal flow. We'll have to go all the way through that foreclosure process. So for us, just to be very clear, our philosophy is to do workouts, do the loan modifications you see at the top. Let's take a look at what that looks like realistically, okay? So the 3 possible outcomes with non-performing notes: loan modification. We'll park it here for just a minute and talk about this very important component. The loan modification on this particular property results in reinstatement, which for us, we calculate 4 months of payments. We're typically asking for 4 months of payments to reinstate. 6 months of payments after that, and I'll tell you why those are calculated together in just a minute, equals $12,775. It's because we're going to turn around and sell that note. That's the back end for us when we do loan modifications, okay? We're going to turn around and sell that note after holding it for 12 months for approximately, this is our target, sometimes a little higher, sometimes a little lower, but roughly 85% of the face value of that note at present, which will be estimated to be 119,212. So we take that number, back out what we purchased this asset for, and we're looking at a $57,655 profit. Not bad at all, right? You see some very, very sizable results, very positive investment results with non-performing notes. So loan modification, remember, that's 50% of our annualized deal flow. We would love it if it were 99%, right? That's where we really want to be. It's a great outcome for the borrowers, great outcome for us as a business exercise. So cash for keys, another 25% of our annualized deal flow. We end up taking the property back, market it with a licensed realtor, sell it roughly 90% of fair market value. That'd be $148,500 less. What's this $5,000 about to the borrower? That's the cash for keys, right? That's to help them in a very professional way move on to their next best housing option. Now that cost for the marketing and helping that person move on altogether is the $89.10 plus $5K. We balance that all out, and the closing costs, we end up at $60,258. Now, okay, not monumentally different, right, than this number over here, the $57,655 with loan modification, but here's what we need to pay attention to. In exit plan number 2, the cash for keys, we have taken 6 months to a year, right? Loan modification can many times be done inside of 6 months, okay? Now, it could take longer, that's the truth, but most of these are done inside of 6 months. So we're positive cash flow in under 6 months, where here, we're almost certainly over 6 months, between 6 months and a year is the typical scenario. Now, exit plan number 3 is the 3 possible outcomes with non-performing notes. It's foreclosure, folks. And again, we have no desire to do this. There are real estate firms that is their intent. That's their philosophy, to pick up non-owner occupied properties, and that's just what they do. They feel like that's their best business option. I'm not making a value judgment. That's not good or bad. It's just our philosophy. What we want to do is help people stay in their homes where necessary, and we've been very successful at that. So even with all that said, we do have to foreclose on about 25% of the properties. People just walk away from them, bury their head in the sand. And in this situation, looking through the numbers, folks, you'll see that it's not really different than the cash for keys. The numbers are really static. This $5,000 is simply going to go to an attorney to execute the foreclosure instead of the borrower, who frankly could have used it to move on to their next best housing option, right? Here's the critical point. This is going to take over a year and possibly up to 2 years, right? When you have to go through the entire, now it depends on what part of the country you're in, right? We deal primarily, we work in 47 states, but we deal primarily in 7 where we know that the foreclosure process is going to work more quickly. So let's just ask a very basic question. Which one of these note investing options works best for you, right? So let's think through this for a minute. We know that we have performing notes that offer a lower risk, consistent cash flow. And we also have, on the other end of the spectrum, non-performing notes that are providing higher potential returns, uncertainty, though, as to whether there will be a foreclosure or not, and there are asset acquisition opportunities. You could pick up the property. So in my opinion, real estate note investing, these 2 options together represent the best way to invest in real estate. You can enjoy an above average return on investment. It's just a matter of avoiding the pitfalls that come with being a landlord or rehabbing properties. That's why I've chosen to do this, right? I was a landlord, used to rehab properties, bought a lot of pre-foreclosures. If you're out there doing that business, please understand I love it. God bless you. I hope you do well with that. But I am not terribly interested in dealing with tenants, toilets, taxes, termites, any of that stuff. You can have it. I'm not going to be competing with you. It's a great business. Did it for a long time. But, we like the scenario where we have note investors. We have property owners paying us monthly, right? It's a beautiful thing. So property owners pay their own property taxes and handle their own property maintenance. The people, we have all owner occupants, right? That's what we do. That's the beauty of this business. So let me pause for just a minute before I get ready to turn things over to Nicole. with Madison Trust. And let me tell you who handles all of this for us, because certainly I don't do all of this on my own. I am the principal of the company and I do negotiate our transactions, but we have a team of loan servicing professionals, insurance professionals, title services, legal advisement, and they all help us mitigate risk, right? Without this team, we really couldn't function in this space. We have to have all these different groups helping us with professional management of these note investments. So, final tips and takeaways. The decision to invest in performing or non-performing notes is really going to be about your own risk tolerance, right? Are you prepared to go out on the wild side? As I put it, are you ready? Have you been a real estate investor? Do you know what it's going to be like when you have to wait 5, 6, 7, 8, 9, 10 months to get through an investment to a positive cash flow position, right? These are very realistic things you need to think about if you're going to consider, and I'm not trying to dissuade you, but I want you to really think about this, and we'll have more conversations with you if you're interested, but you should consider those things if you're even thinking about non-performing notes. So I invite you to continue our conversation about how note investing can work for you and whether performing or non-performing notes would work best. How can you do that? Well, let me just tell you, to continue the conversation, I invite you can simply give me a call. I'm in our offices right now in the greater Cincinnati area. I'm in here Monday through Friday, generally between 10 a.m. and 4 p.m. You can give me a call at 888-922-0788. You can email. One of the easiest ways to get in touch is you can go on our website, FiveWB.com. As you see here, click on the link that says Work with Me. And we'll do what we call a discovery call, folks. Okay, so I invite you to do that. You'll come on. We'll talk about honestly, sometimes I have these conversations with people and we just find out it's not the right fit, right? And that's okay too. I want you to feel very comfortable getting in touch, having a discovery call, talking through this to see if these type of investments are a good fit for you. I love them. I'm wildly biased. I have to be honest with you. I think they're the best investment, but we'll talk through it and see if it's the right type of solution for your risk profile. So thank you so much for walking through that with me. Nicole, I am going to designate you as host. And thank you so much for telling us about Madison Services.
Awesome. Thank you so much. Perfect. It says I'm the host now. I'm just going to share my screen here. Let me get set up. Perfect. And then let's see. I want to make sure that we can go full screen. Maybe it's this one. Okay, perfect. Okay. Can everyone see my screen?
Yes.
Okay. So thank you so much, Jerry, the managing member of FiveWB, for featuring Madison Trust Company as their special guest this evening. My name is Nicole, and I am a part of our sponsors team at Madison Trust. I work alongside our account manager, Ian Robertson, who's also on this presentation tonight. Our roles at Madison Trust are really designed to provide a customized service for every single investor and investment sponsor that comes our way. So really, we're super excited to discuss self-directed IRAs, the purpose of them, and why we think it could be very beneficial to you to further diversify your retirement, maybe into some popular alternative investment opportunities. So really, you may have heard about what a self-directed IRA is, but you may not know how it works, which is probably what led you to this webinar today. The answer is simple. A self-directed IRA is all about the investors. It's about you. You are able to take control of your retirement and invest into assets that you're passionate about. A self-directed IRA is a type of tax advantage or tax deferred account an individual can invest through. And we are the vehicle that helps an investor connect those retirement funds into an alternative investment of their choice. So speaking of some alternative investments, we see real estate, private equity, promissory notes, precious metals, and so much more. Ian can attest to this, that our clients are very creative on what they like to utilize their retirement money into. We've seen Arabian racehorses, we've seen agave plant farms. People are very, very creative I think one of the most popular alternative investments I've seen this year is promissory note lending. Many people don't know that they can lend money from their retirement account to be placed into an IRA, uh, placed from their IRA into an alternative investment. Um, and people don't know that they can lend that money to a colleague, a friend, or an entity as well. So, Ian, can you just tell us a little bit more about how an investor can get started at Madison Trust and what the typical process looks like?
Yeah, absolutely. Happy to. Um, even before starting with Madison Trust Company, the first thing I'll always recommend to anybody is to hop on an initial call. I'm happy to hear where you're at right now, what you're planning to do, make sure that we're a good fit for you, that the self-directed IRA is a good fit for you. Obviously, investment decisions is your wheelhouse, but we're here to make sure that this is something that can be serviced for you. For example, um, where your funds are coming from. Like, are you just starting from scratch? Or are you transferring from another IRA? Do you have a 401k somewhere that you want to bring over? So those are important things to talk through before getting started. Once you are ready to get started, it's very simple, very straightforward. We continue to
Mhm.
improve the process and better streamline it every year. So we're getting a lot better at that. So what you do, you go through our online account application. Shouldn't take more than 10 minutes to go through our client portal, set up your login information, put in your information, sign the application. You're all set. You get your account number instantly. You can then click the section to fund your account, initiate a transfer request, or we give you the information to roll over 401k funds. However, you're funding your account, we give you those instructions. And then once the funds are in the account, or even before the funds hit the account, you can start working on the investment process. So, our investments department needs to see certain documents specific to the investment opportunity that you're going to be pursuing. Make sure that everything shows the IRA as being the investor instead of you personally, as an example. And our team will walk you through what exactly we need to see in terms of documentation and how it needs to be filled out. Then there's a quick online form through your client portal that you'll fill out, telling us where to send the funds, authorizing us to release them, and you're all set. We take it from there.
Mhm. Yeah, and I mean, working with our investment sponsors like Jerry in advance also helps the investor through the investment process. We're collecting the blank documentation first so that we know we can custody this and investors can get through that process pretty seamlessly. Ian's always there as a resource too if you have those questions to ask during the onboarding time. As with any investment opportunity, we always encourage clients to really do their due diligence on the alternative investments that they choose to hold within their IRA account. We are known as a passive custodian, so we're really unable to provide any tax, legal, or financial advice. So, as Jerry did at the beginning of this presentation, we will also do it as well. We just have to be mindful that it is a self directed IRA, so it's up to the investors to self direct their investment. Um, let's talk a little bit more about the benefits of a self-directed IRA. The first benefit I can see is portfolio diversification. A self-directed IRA can invest into alternative assets that are completely off limits for regular IRAs. So an investor can diversify their retirement into a friend startup company, a fixer-upper that they may have seen down the street. Many people, as we said at the beginning, are very creative. So it's always up to the investor to think outside the box, and maybe it can be held within a self-directed IRA. Hands-on investing. So the IRA account owner, not an investment broker or even a custodian, chooses the investments for the self-directed IRA plan. You may be able to direct your broker when to buy or sell in a conventional IRA, but regular IRAs don't allow you to invest into alternative assets. So the options that you have of investing through a self-directed IRA can help you really diversify into bigger opportunities that you may not see in a standard brokerage firm. And last but not least is stability. So an investor can hedge against the volatility of the stock market and place investments that have a steadier and more reliable revenue stream. Our investors don't have to rely on the rise and fall of the stock market. They can buy or sell investments through their self-directed IRA when they decide to. So Ian, we know that there's a lot of self-directed IRAs that are out there. Can you just go into a little bit more about what sets Madison Trust Company from the rest?
Yeah, absolutely. So the three things is as seen on the screen here is going to be our support, our fees, and then our expertise. And so in terms of support, the biggest thing that I always tell people, and it's also seems like it should be the simplest thing, is accessibility to our team. You don't have to wait on hold for hours on end or wait weeks to get answers to your questions or any nonsense like that. We are here. We're real people. We have trained staff all happy to answer your calls or your emails with any questions that you may have or any service requests you may have for your account. So that's a huge difference. Again, it's seems so simple. It seems like, oh, everybody should be able to do that. But it's just
It's
not the case.
not. It's
It
not.
really isn't. So beyond that, we don't believe in charging fees based on the value of an account. You're the one making the investment decisions. If your account increases drastically in value, we didn't do anything to deserve more money out of that and charge you more fees because of that. You should be rewarded and have better value in terms of how much we're charging versus how much you have invested. And so it's flat rate based on the number of investments that you have instead of the value of any of those investments. Because again, we're linking it to the work that we're doing, and based on the number of investments, that's what would increase the work that we're performing for you. So straightforward, flat rated fees. We try to make it as simple as possible to understand our fee schedule. It's one page to the point. And then last but not least, our industry knowledge or expertise. Our staff is all very well trained. We go through trainings all the time for all sorts of different functions within the industry, specifically self-directed IRAs, IRAs in general, alternative assets and asset classes. So there's a lot that we go through to make sure that we're well versed to answer questions that you have and to provide the service that you'd need for an account with Madison Trust Company. We've got about 20,000 clients, about $5 billion under custody, and we serve clients in all 50 states, even some abroad as well. People love the service that we're providing for good reason, as I just mentioned.
Mm-hmm. Yep, I got to update this slide then because this says $4.0 billion under custody. But when we have helped investment sponsors raise over $100 million in capital through this method. If you're like Jerry and you're able to understand that self-directed IRAs are a fruitful option for your investor base, and it can help clients really raise additional capital and grow their retirement wealth. And last but not least, here's us. If you have any questions or if you'd like to hop on a call with us, maybe you're interested in customizing your retirement towards, into a promissory note or something like that, please let us know. And that's our contact information. I'll leave that up there for a little bit. Now is a good time, I think, for us to dive into any questions. Maybe Jerry, if you'd like to ask Madison Trust some questions, or anybody else on the call as well.
Well, I want to make a comment for sure. I mean, what Ian was saying about the flat rate nature of your service, that's somewhat unique. Not every custodian operates that way. So I'll definitely compliment you on that. That is a great benefit.
Yep. I mean, I can say that our executive team at Madison Trust started this company because they had a self-directed IRA custodian elsewhere. They felt the fees were skyrocketing, and they also didn't have a direct go-to person or people at the custodian. So service is of the utmost importance, as well as keeping our fees affordable for each investor at Madison.
Right, absolutely. I really thank both of you for taking the time to go through and explain this. We're going to, of course, take the recording of this and replay this for our group and let them know the great work that you all do, how this can help them, and, really just making functional their plans to dive into note investments. If there is a question, certainly we can do some Q&A as we wrap up here. Do we have any? Okay, maybe not. Nicole, Ian, do either of you have questions about what I presented, about what 5WB does with these wonderful performing and non-performing notes?
I do have a question.
Oh, all right. Go right ahead, sir.
Yes, you mentioned, I think you said 47 states that you can do loans in, or that you have done notes in.
Absolutely. There's three others that we just hate. No, I'm just kidding. We don't hate any states. We love everybody. But there are three states that we're not barred from working in them or anything like that. We can work in them. We just we choose not to work in them. It's all about the estimated time it takes to execute foreclosures, Ian. And so what that means is, for us, it's just a philosophical business decision, right? We don't do business in the state of New York, state of California, and the state of New Jersey. Okay. We can, okay, we can. We just choose not to, and it's literally for that reason. Lots of awesome people in those states. If you're out there watching this, I'm sorry. I hope I didn't offend you.
Including us. I'm from New
Exactly.
Jersey and Ian's from New York.
Exactly. Sorry, Nicole, didn't mean to offend anyone, but your home state just takes too stinking long to get foreclosures done. And it's the regulatory nature. And, the truth is really, Ian, that while we work in those other 47 states, we really focus in about 7. And, people, of course, oh my gosh, where are they? Where's the sweet spot, right? Let me just back up and tell you, there's no secret hunting ground for great notes. Okay, they're all over the place. But what we have done is, I'll tell you a few of the places. We work in the Carolinas. We work in Florida. We work now. If anybody tells you they work in a note business and they say they have never worked on a note in Texas, they're probably really not in the note business. So we work in Texas as well. The great state of Texas is an amazing place for note investors. We work also in Indiana, Tennessee, great deals there, Ohio. So a lot of different places. Really love working in Tennessee, Florida, the Carolinas, and Texas, as I said. And, folks, it's really just about having a successful, repeatable approach. Why would you not continue to operate in 7 states that perform very, very well, right? The only reason that you'd ever be forced out would be capacity issues, right? And at present, we're not having a problem with that. We're finding all kinds of, great transactions, especially on the non-performing side. So hopefully that answers your question. Those are the 3 states. That's why I have to explain that a lot to people, and inevitably it ends up offending someone like Miss Nicole. I'm so sorry about that. But that's why, because as a function of profitability, it just brings too much unknown and uncertainty with those extended foreclosure times.
Absolutely.
Anything else you or Nicole would like to know?
So you've been in this industry for quite some time. Can you tell us, maybe just share some light on the success that you've seen from clients utilizing self-directed IRAs into a promissory note?
Yeah, I'll be glad to. We actually have someone on the call with us right now who I've worked with closely recently entering into that. I don't know if Anna will care to participate or not. She may be shy, but I'll invite her to share a little bit about the experience. But I talked about the fact that when you buy a note, you're really becoming the bank, right? And I know that that's something that greatly appeals to Anna, who's on the call with us now. I've worked through a transaction with her over the last few weeks. And, when you talk about progression, I basically started where Anna just entered this business at within the last couple of months, about 10 years ago. And at that point, was working with very different types of real estate investments. Like I said, pre-foreclosures, landlording, lots of things, all kinds of wonderful landlording issues. And those are very good things to do. They're great investments. But what I like about this, Nicole, is the simplicity and the efficiency, right, of this. And you have to manage your investments. That doesn't change at all. I know, Anna, from talking to you that you've been enthralled and pretty enthused about the note industry. Nicole, I want to just back up for a second because I think that Anna might have something valuable to add here. What would you say about let me just ask the question, what would you say about your introduction? Because now you've completed a note investment transaction with us. What are your thoughts on that?
Well, I think it starts with you don't know what you don't know. So before I met you, Jerry, I didn't know about notes. And I was looking everywhere. Like, what do I do with the money that I saved all my life? I've been working for decades. And the stock market was not giving me the return that I needed, and I didn't have the control that I needed.
Mhm.
So when we had our discovery call, I had a lot to think about because that was very different and very new to me.
Mhm.
And then after working with you after the second call and looking at examples of things that you had to offer and what kind of deals we could do together, it opened up so much for me. Now, all the money that I have on my retirement is working for me. And I know that it's safe as it can be. Nothing is 100%, but I know that it's safe. It's cash flowing. It's money is coming in. I can see it. So that makes me feel so good that you helped me with that. And then I feel safe that that money is going to be there in 10 years when I retire. And also, I'm so excited about it that even with the money that I have that is outside my retirement accounts, I want to invest in notes with that money too. And look at some non-performing notes because with my retirement money, I want to play it very safe. So performing notes, but with the money that it's outside of that account, I can play a little bit more. So I'm super excited to start that. So that's it.
Well, that's cool. I appreciate you sharing. And I know that you've had a great exuberance for learning about this. And, Anna and I have joked about this, Ian and Nicole, over the last few weeks. But when I talk about people being the bank, she has actually, in fact, launched the first national bank of Anna McKnight, right? And then, we joke around about that. That's all done, within her IRA. But that's really what we're inviting people to learn how to do, Ian and Nicole, is how to set up themselves in that position where they can not only financially benefit from, but make decisions and invest like a bank. And as Anna said, it does open up an entirely new opportunity of awesome investments.
Great.
I think so. Yeah, absolutely. We've actually
Thank
had a
you.
lot of fun doing this. Anna and I, she's way across the country, but we've talked a lot and really had a lot of fun designing, how she's investing. I obviously welcome the opportunity to have discovery calls with other folks and tell you how this may or may not be for you, right? I'm very realistic about this. I tell people there's no investment class that's for everyone, right? But investigate it, look into it. We'll do our best to give you accurate, educated opinions on what is available in the current marketplace and help you through the process. And frankly, Nicole, it's usually, at least a few weeks, right? Like this, this is, as Anna said, it's retirement funds. These are not things that we want to make snap decisions on. We want you to slow down and make a well-considered decision, a very educated decision. So I think that's pretty much everything I would have to say to answer your question, Ian. I hope that that fills you in. If you want to ask something else, feel free. But what I encourage people to do is engage with these discovery calls, and that's really, Nicole, where we dive into the situational part of these investments for each individual person. Look at where they're at, what their goals are. What's your time, what's your time horizon? When are you gonna, when do you want to retire? When do you need for this to start reverse engineering an income for you? And at what point does that have to happen? All very important questions. So thank you so much, Nicole, for making the time available for us to talk with you and with the good folks at Madison Trust. I appreciate it. Thank you, Ian. Everyone will receive access to a link with this recording so that you can get back in touch with the folks at Madison Trust and can get in touch, of course, with us at FiveWB if you'd like to do so.
Thank you so much, Jerry. And thank you, Anna, for all of your insight. It was wonderful.
Yeah.
Thanks,
All right.
guys.
Awesome. Thank you, Ian. I'm going to go ahead and wrap us up. I'll stop recording now. And thank you very much. I hope you all have a great evening. Thank you for your time.
Bye.
Have a good one. Bye.